Good afternoon. I'm Anuj Mehrotra, Dean of the George Washington University School of Business, and I am delighted to welcome you to this session in the George Talks Business series. Please join me first in welcoming our moderator, Professor Rodney Lake, co-chair of the Department of Finance and the director of the GW Investment Institute at the George Washington University School of Business. Thank you, Professor Lake, for serving as a moderator today. And now I'm delighted to introduce our distinguished guest, Dr. Sam Priyadarshi, Principal and Global Head of Portfolio Risk and Derivatives at Vanguard. Dr. Priyadarshi leads a global team responsible for market risk management of active fixed income funds totaling over $158 billion and for the trading of over $1.2 trillion annually in cash and derivatives instruments. He is the chair of the Technology Steering Committee, member of the Market Structure Committee, and the LIBOR Steering Committee. Dr. Priyadarshi has more than 23 years of investment experience and is a member of CFTC's Market Risk Advisory Committee and serves on the advisory board of UCLA Anderson School's MFE program. Please join me in welcoming Dr. Priyadarshi. Thank you for joining us today. And take it away, Rodney.
Thank you very much, Dean. Appreciate it. My delight and pleasure to be moderator for this panel today for George Talks Business. Very exciting time here. And our guest, Dr. Priyadarshi, may I call you Sam to start with?
Please do. Thank you.
Thank you, Sam. Very much appreciated. So, there's a lot going on in the world, and certainly in the world of investments, and Vanguard is right at the front of all of this, at the vanguard, you might even say. In any case, there's something that many people are focused on and many people know about. There's a presidential election that you might have heard about in the US, and all of us might be aware of. Just from your perspective as an investor, how has this impacted what you and your team have been doing, and how is it likely to impact what you're going to be doing moving forward? Are there policy changes that you're anticipating? Are there things that you're thinking about hedging for, planning for, investing for that are very specific to this election?
Sure. Well, first of all, thank you, Anuj and Rodney, for having me. I'm honored to be invited here today, and I'm looking forward to our discussions. So, Rodney, you asked about the implications of the election outcome and what the market is pricing right now. So the odds of a prolonged election that is not called until Friday have gone up, as have the odds of a prolonged contested election. So going into the elections, the market knew that Wisconsin and Michigan were going to be late reporting, but the odds of a blue wave have dropped considerably. Republicans could potentially keep the Senate, which won't be known until January due to the runoff elections in Georgia. A contested election and a divided government was not the consensus view in the markets. So if the presidential election is contested, then we could have a risk-off situation in the markets and a flight to quality. The size, scope, and timing of this fiscal stimulus will be the big question under a Biden victory with a split Congress and a divided government. It may be hard to get any fiscal stimulus done in a lame duck Congress. The market is expecting a stimulus of around 500 billion to 700 billion under a divided government, down from an expectation that the market had under a blue wave scenario of $2.5 to $3 trillion. Now, given that we have a much lower stimulus package expectation, the market had initially positioned for a blue wave, a big fiscal stimulus package, and the reflationary impact of that fiscal stimulus. Now, that outlook did not pan out last night, and the rates market has rallied in a flight to quality, while stocks are rallying as the tax reforms proposed by the Biden campaign won't happen, and the chances of a big tech breakup are going away. Now, the course of COVID-19 virus, sorry, go ahead, please.
Sure, I was just going to ask a quick follow-up on the flight to quality, just for all of our viewers. Where do you expect that flight to quality? Is it going to be in the traditional asset classes like treasuries, or do you see other assets benefiting from a flight to quality, and how's your team positioning for that?
Sure. So what flight to quality in this context means that treasuries are rallying and rates are dropping and their prices are going up. But conversely, we are seeing that a risk on scenario today where stocks are rallying hard and correlations between stocks and bonds have broken down because of the zero lower bound policy being pursued by the Fed as rates are floored at zero. So typically you have a negative correlation between stocks and bonds. But right now, we are seeing that treasuries are rallying as well as stocks are rallying. And treasuries are rallying because of a large fiscal stimulus under a blue wave would have been reflationary and rates were expected to rise under that scenario. And the markets had positioned for that, but that didn't play out. And we don't expect a blue wave to happen, although the outcome is yet to be known, both in terms of the Senate as well as the presidential election.
Thank you. And another follow-up question around the interest rate market in general. Is it your anticipation that we're going to have this type of easy money policy without the reinflationary pressures you mentioned from a blue wave moving forward? So is Jay Powell likely to keep this stance? And if so, why do you think that? And if not, why not?
Sure. So I think the Fed will stay low for long. And the Fed has stated that they will not even thinking about raising rates. And the reason for that is, let's say if in an election outcome, we get a big stimulus package passed by the Congress, which is highly unlikely right now, but that would be reflationary. But the Fed would immediately step in and go ease the rates and put a lot of QE and duration buying to work to get the rates lower back because that would be stimulative to growth. So the Fed is focused on the economy and growth while rates, markets, and stocks are immediately pricing the outcome of the election.
Thank you. So I think everyone has an idea that the election will be settled at some point. So let's actually move on, given our time here today. So one of the things that is obviously at the top of everyone's mind as well is COVID and the impact of COVID on the markets and the economy. What are you seeing from your perspective and your team's perspective of what the likely outcomes that the market is pricing for that? And do you anticipate that the market's correct about that or not correct about that? Or how does this play out for the markets for the next 12, 18 months?
So that remains the huge uncertainty on top of the election, uncertainty around the election. So the trajectory of the COVID virus, as well as the trials and the production and distribution of the virus, will play a huge role on how we reopen the economy and the transportation, travel, hospitality sector, and indeed the economy at large, schools, and so on. So that will have a huge impact on the growth. And if we get an early vaccine and potentially medicines to cure this virus, then we will have a surge in growth. And that might happen either in the first quarter or in the second quarter. But right now, it looks unlikely that we will have an outcome which might be known before the first quarter.
And then just anticipating, let's say there are some therapeutics by the end of the year, and there's maybe even a vaccine, let's say first quarter. What do you think the implications are for the equity markets, given that some of the economic fundamentals have not yet come back, but people are pricing, obviously, for future opportunities? That's the jobs of the market. Do you think that the market has miscalculated that at the moment, or do you think that the market has this, for the most part, correct?
I think the market expects that a vaccine will be developed soon, whether it happens in December or first quarter or second quarter. The market is expecting a vaccine for the virus, that is. So the market has been rallying in that expectation. Now, how it plays out will determine whether the markets continue to trend up and it's positive for growth. So the economy will then react to the timing of the vaccine. deployment. So I think what you're saying is right, that the market is closely watching the vaccine development and deployment, and it's in anticipation of that has been rallying. The stocks have been rallying. Now, um, if it turns out that we don't have a vaccine and we go into lockdowns as we have had in Europe, then it would not be good for the economy and growth may go down as we saw in the first 2 quarters of the year. And the market will adjust to that.
Excellent. Just moving on, we have a few more topics that I would like to cover. So just being mindful of that. So the next topic that I would like to jump into, and it's a very broad one, but it's technology, and certainly technology as it's applied to the investment world. And so, for example, some of the things that we talk about in our classes here at GW is that technology is changing the environment. The preparation for students obviously is first and foremost, and one of the things that we care about. But technology, and specific to, let's say, machine learning or AI, has changed the investment business, and so no longer is it a small part of the business. It's been growing quite dramatically, and I think Vanguard here has also been at the center of some of this. So it would be very interesting for us to hear about what your view is for how technology has been impacting the investment business, the investment market overall, and certainly how it impacts people who might be thinking about joining that as a profession.
Certainly. So in terms of technology, we've over the past 2 decades, we've seen a large scale digitalization of the markets. Exchanges have transitioned from being physical exchanges to digital exchanges. And instead of open outcry, we have computerized matching. On electronic exchanges, the dominant form of trading is using algorithms. And increasingly, the entire workflow from portfolio optimization and order generation to execution, post-trade electronic confirmation, and settlement is automated. And the markets are using blockchain or digital ledger technology for index data and collateral management. So there's increasing use of technology, machine learning, and artificial intelligence in the asset management industry, and it's increasing at a fast pace. For example, it's being used for data analytics, underwriting, and anti-money laundering. We use natural language processing or NLP for sentiment tagging of financial news and extracting data from financial statements. We are also seeing an increase in the use of alternative data in financial research. To give you an example, satellite imagery of parking lots at shopping complexes, farmlands, freight containers, and also personal data like browsing and shopping history, online reviews, and another example would be like geolocation data or GPS tracking data. So technology is pervasive, and I would say that students that are coming out of business schools uh, should prepare for uh, a business world that is increasing going to rely on technology and machine learning and artificial intelligence, and they would do well if they learn modern programming languages like Python.
So a quick follow-up here is, how has that evolved over the last, let's say, 10 or 15 years from your perspective? Let's, put some percentage 10 or 15 years ago, and what would that percentage be today, just to give some context for some people who may be thinking about the business or know the business well, but would like additional insight. Has that gone from, 5 to 80, or has that gone from 0 to 100? What's your view?
So let's say a decade or two ago, we would hire people from business schools to work in the financial sector, in investments, for example, and they would have a solid training in finance. And then when they would come on the job, they would go through rotations and they would learn on the job. But training them for technology would be challenging because they didn't have a technology background. We would, on the other hand, we would hire quants who would have a good technology background, but not complete or full knowledge of the markets, and we would have to train them on the financial markets. So what has increasingly happened is that we are seeking candidates that have good knowledge in financial theory and practice, but also a fair degree of comfort with technology and modern programming languages. So if they are ready and prepared in not just their financial knowledge, but also modern technology and programming languages, then they would fare very well in a competitive world. And we've seen
Thanks.
that increase from maybe 20% to call it 50 to 60%. So it's become increasingly important for candidates to position themselves as not just good at what they do in their course major, but also in technology.
So this is a follow-up question on that, and this is getting a little bit specific, but just out of curiosity, are you competing now with talent directly with the technology companies? And is that changed over that time? So now is the person who's deciding between Vanguard, it's not between Vanguard and let's say Goldman Sachs Asset Management, is it between Vanguard and Amazon now? And how has that impacted your recruiting?
So when we recruit from undergrad and from MBA courses, we are indeed, so many of our talent pipeline are looking at technology companies like Amazon and Google, but we do tend to attract people that have passion for the marketplace or financial markets, and those are the kind of candidates we look for. Now, if you're talking about data scientists, then it's a very competitive talent market there. Both tech firms as well as financial firms are vying or jockeying for the same technology candidates. But in terms of people that we hire for trading, portfolio management, and investment research, those candidates have to have passion for the markets. And what we are talking about is that the degree of technology or programming expertise that they might have needed to have in the past has gone up now.
Fantastic. Next line of questions are really from a related but different part of the business here, and it's the move from passive to from active rather to passive investing. Jack Bogle, Vanguard, obviously a pioneer in this, and now Vanguard is trillions of dollars to demonstrate that that's moving in that direction. But how do you think that that's working now? And it seems like over the last, let's say, especially 5 to 10 years, and let's pull it back all the way to 2008, that passive investing has really outperformed many active managers. From your perspective at Vanguard, do you think that that trend is likely to continue? Are there nuances within that trend that we should better understand? And what's the market look like moving forward?
So certainly, Rodney, passive or indexing has been on the rise over the past decade or so, as you mentioned. And Vanguard's value is that we offer both passive funds and index funds. Now, we've seen an explosive growth in our passive business. Our indexing franchise has just increased in multiples, but we've also seen an increase in our active fixed income business. For example, Vanguard today manages 6.6 trillion, of which 2 trillion is in fixed income, and of that 1 trillion is in active fixed income, including money market funds. So we've seen that our clients, they have a choice. We give our clients a choice whether you want passive, if you just want to track the index. And for many people, that might be the solution. But for many other clients, we also offer high-performing active funds, but we do both at low cost. So investors, whether they select active fixed income funds, which have actually beaten a lot of our competitors, 85% of our fixed income funds have beaten our peer group. And but we offer both at low cost. And that's the value proposition that our founder, Jack Bogle, offered to our investors. So at Vanguard, our core purpose is to take a stand for all investors, to treat them fairly, and to give them the best chance for investment success, whether it's using our passive products or active products. So there is a room for both to grow, both the passive as well as active business. And what we tell our clients is to have a long-term view, whether you're being a passive investor or an active investor. But our value proposition is that we will offer high-performing active funds at low costs.
Thank you, Sam. Another trend in the market, and it affects large money managers and even small money managers, let's say. One of the ideas that has been out in the market is the idea of ESG. And BlackRock, for example, has taken a very definitive stand on what they think about that. I'm curious what your view of that world is, its importance, and the likelihood that it will be as important moving forward.
So I think we all agree that climate change is real and that the world around us is paying more attention to equity in society, in governance, and gender equality, and the um, sustainability issues. So many investment firms, including Vanguard, have taken the approach of offering the right mix of ESG products to our clients. We have seen an uptake in ESG investing from millennials who care deeply about our climate. And I think that the focus on ESG investing will increase, but also the disclosure on ESG from conventional firms and industries and our holdings will increase, and they might be filtering our portfolios, non-ESG portfolios based on ESG scoring. So there's both going on in terms of the rise of ESG investing as well as disclosures, financial disclosures about ESG issues from traditional companies. We are also seeing the rise of green bond issuance from companies, for example, in the solar business, et cetera. And that also is a rising trend.
So two things on to follow up there. One is, what do you think the role of passive investors with respect to ESG? Are they going to make a difference? Let's say in the proxy voting, you talked a little bit about the disclosures that come out of these companies. Do you think that the passive investors are going to have a not unlike Vanguard and BlackRock and others are going to have a big influence in the index companies because of the way that they're voting their proxies, or how do you think that will play out?
So traditionally, investment stewardship and proxy voting from passive asset managers like Vanguard has been to look at the decisions made by the boards and the executives, but not harshly critical of their approach on ESG. But that is changing. Many firms, including Vanguard, require a diverse board of directors with gender representation, increasing gender representation. So that is one issue. A lot of asset managers are insisting on sustainability and environmental and social governance issues, and they're holding their votes based on ESG issues. So we might see a shift in the stewardship and proxy voting from passive managers, as they could be the largest stockholders of any given stock.
And just out of curiosity, you're on the fixed income side, as you mentioned, and that's a big part of the business at Vanguard. What's your view of the green bond business? So you had mentioned that that's evolving, but what does that look like, let's say 5 years from now or 10 years from now? Do you think that that's going to be a staple of people's portfolios? They're going to make an allocation to green bonds, or do you think that that's going to be a little bit of an alternative for a while and it'll take some time for that business to grow?
Yeah, you're right, Rodney. Right now, it's a little bit on the periphery of traditional investments, but as it becomes more mainstream and as companies and governments issue more green bonds, uh, then we might see an uptake in investor interest. Now, ultimately, investors and portfolio managers decide on what's the right thing for their clients and their portfolios, whether they're green bonds or traditional bonds. Now, as we see more and more issuance, there could be a reason for investing in green bonds because they either are in the index or they provide good returns. Now, we will definitely see an increase in green bond issuance. Indeed, the climate policy under the Biden campaign talked about infrastructure spending and green bond issuance, and we'll see how that plays out. But it's fair to say that this topic of green bond and the rise in issuance and investor interest will continue.
Thank you. And now to move on to really start wrapping up our discussion here today is, we may have some people that watch this that are current students at GW. We always love if they're participating, but it could be students otherwise. But it could also be people thinking about making career changes and the like. Please talk a little bit about what career advice, let's say, you would give to make it an undergrad or a grad student. What are some of the things that they should be thinking about? So what are some of the habits they should be creating? What are some of the things, if you were a student right now, that you would be studying, and recommendations for, what type of activities can they do to make themselves better positioned for the current market?
Sure, Rodney. So what do we look for when we're recruiting from colleges? We look for intellectual curiosity, learning agility, an exploratory mindset, quality of decisions that you've made during your academic life, having a problem-solving mindset, and of course, emotional intelligence. And layered on top of this is that we're looking for a diverse pool of candidates. For roles in trading or investment research or portfolio management, we look for candidates with finance training, but also familiarity or proficiency with programming languages. Now, we like candidates that develop a growth mindset by developing deeper investment and technical acumen when they join firms like Vanguard, and we want them to challenge the status quo. So they need to be not just learn theory, but push the boundaries of practice. Why are we doing things a certain way? Why do we need to continue doing it that way? Why can't we change the way we do things? So we need to develop leaders that think along those lines. Now, once they join our team, we want them to value diversity and sharing their skills and knowledge to support the development of people around them. So what I would suggest to students is, be curious, be passionate about what you want to do, and have an open mindset and love learning, because you will learn every single day on the job throughout your career.
And if you had to give advice for a current student to say, here's the number 1, 2, or 3, you choose activity that you should be doing now. Is that reading the newspaper? Is that following the market? Is that building their own portfolio? Is it all of the above? Is it something else we're not thinking about? What can they do to be active learners? And what would you recommend?
Sure. So I would say following the market news is top. We want to understand people that have a passion for the markets, and demonstrating passion. Passion is innate, but you can show passion by being knowledgeable about the markets, and that can come from either personal investing or college-based investing clubs, or or just having a good idea of the way markets work, the Federal Reserve banks, the way monetary policy is decided, and having a kind of a general idea of investment world, and and which is of course changing, and we train them on the job. But the number one, I would say, learning about the markets through financial news, investing either through a college club or a personal, and just having an open mindset.
Excellent. I think that's a great place to finish. And so I want to say thank you, Dr. Priyadarshi, for spending time with us today. And I want to say thanks to all the people online who joined, and certainly all of our fans and alums that participate in this. And so just want to also give a heads up to what's up next for George Talks Business. The next episode will be November 18th, with Nate Morse, who's the founder and CEO of Rubicon and is also a GW alumnus. Thanks to everybody, and this has been George Talks Business. Thank you.